We're taking a look here at the Chapter 17 PowerPoint, and it's going to deal with tax consequences of personal activities. So let's get started at least by looking at our objectives. We want to determine the extent to which prizes, awards, gifts, and inheritances are included in the recipient's gross income. We want to summarize the tax consequences of legal settlements and government transfer payments. We want to compute the tax on gain from the sale of personal assets. We also want to identify personal expenses that result in tax deductions or credits. We want to determine the deductibility of personal losses and describe the tax benefits resulting from home ownership. So, getting started with gross income. They make a note here in case anybody asks you, what Internal Revenue Code section deals with gross income, and that is section 61. And it states that gross income means all income from whatever source derived. And it says it includes income derived from personal activities. I guess we should include in here, we're talking about how we should be doing it. Okay. So looking at personal receipts. Well, sometimes prizes and awards. You win a prize or you get an award. Prizes and awards are included in gross income. Scholarships, well, they can be excluded, except they're only excluded to the extent that they're spent on tuition, books, fees, equipment required by the institution. So what's not on there is room and board. What's not on there is meal plan. Okay. Also, gifts, inheritances, and life insurance death benefits are excluded from gross income. And I guess we should put in here under most circumstances. Looking at legal settlements and government payments. So legal settlements are included in gross income unless compensation for physical injury or illness. So workers' compensation is excluded. So workers' compensation means you're still employed or you're injured on the job, and that's the part that you're getting. That is not unemployment compensation. However, it notes, and this is a change, unemployment compensation is excluded if the AGI is under $150,000. Okay, also need-based payments such as welfare and food stamps are excluded. And then Social Security, as we've seen, is either 85%, 50%, or none of it included in gross income, and that depends on your other activity as far as income is concerned. They mentioned here that the, I guess, legal settlement related to divorce. So property settlements are non-taxable, meaning, the house, vehicles, and what's technically happening behind the scenes is the individual that's getting that property is getting the carryover basis that it had before. So if everything is on a personal level, may not be as important as if some of it may have been held in a business entity. Then they talk about alimony. So alimony, there's a cutoff date. If the divorce happened before 2019, then alimony is included in the recipient's gross income, and then it's also deductible as an above-the-line deduction by the payer. So right before 2019, so through 12/31/2018, it's included in the recipient's gross income, but deductible above the line by per individual paying it. So beginning January 1st, 2019, or as they describe it here, post 2018, it's excluded from the recipient's gross income, so the recipient benefits because they don't have to include it now. However, just like we've talked about before with the matching idea, since they're not including it, it's not going to be deductible by the individual paying it. So not as good. And the last note is important. It says child support is neither taxable nor deductible. So again, it would make a difference if it was a divorce pre-2019. Right, and you work with your clients, and sometimes your clients will tell you how much the payment is, but what they may not even know. But some of that payment may be child support. So even if you're working on a pre-2019 divorce, you really, if I possibly could, look for the settlement or have them bring you that statement, and not to be nosy, but that way you can know exactly what child support is, right? So look for things like either it's going to be noted as child support, or it's going to say payments are what, $5,000 each month until the kid reaches the age of 18, and then it's $2,500 a month, whatever it is. So you can kind of see that $2,500 difference is going to be really child support. That's how it's being treated. So sometimes it's not really clearly stated, but that's why looking at some of those can help you know really what the alimony is. And again, if it's after 2018, it might become a moot point unless it goes back to the old rules. So then they talk about personal use assets. So personal use assets are personal use assets, meaning you use them for personal, you do not use them for business purposes. So your own vehicle, for instance, you cannot depreciate that. Gains realized on the sale are capital gain, and losses realized on the sale are not deductible. Right, so why do people not usually run into an issue with this? It's hardly ever that you buy a new vehicle, use it for a while and sell it, and actually sell it for more than what you paid for it. Right, so I don't know that the IRS goes after that scenario all that much anyway. But if that was technically a gain, I guess you they could require you to file that. Then they mentioned this idea of personal expenses. Right, so this is no deduction allowed for personal living or family expenses except for, and these are really more or less your itemized deductions. Your medical expenses, certain taxes, home mortgage interest, and charitable contributions. Looking at medical expenses, taxpayers may deduct the excess of unreimbursed expenses over 10% of AGI as an itemized deduction. So looking at the Schedule A, and we'll get some practice looking at that. Qualifying medical expenses include things such as clinics, hospitals, long-term care facilities, doctors, dentists, chiropractors, medical travel expenses, medical aids, meaning hearing aids and crutches, prescription drugs, and medical insurance premiums. Right? Sometimes you'll have individuals bring you things such as they had cosmetic surgery. Right, so you need to make sure if it's cosmetic surgery, if it was for a medical reason, you can deduct it. If it's just because they wanted to look better and there's no medical reason for it, then that's not deductible. Then they talk about taxes. So individuals are allowed an itemized deduction for your real or personal property taxes on non-business assets. So wherever you live, if you pay property taxes on it, and your vehicles, things such as I guess even trailers and things that are not part of a business, you can get the tax there. And this next one is important. You either get your state and local sales tax, or you get your state and local income taxes. And currently, this is something that changed not for the better. Currently, if you take your state and local income taxes, it's being limited to $10,000. Right, so that's one change that did not really help the taxpayer. The other thing is that if you paid foreign income taxes, you can get a deduction instead of a credit. When you use your software, you pretty much put in what your foreign taxes paid is, and it'll help you determine which is better. It might be better to get a credit, a lot of times is, but if it is better to get the deduction, it'll help you figure that out. But that's really what it's running through in the back of its mind or program. And then here, let's look at charitable contributions. Right, general limit means your itemized deduction limited to 60% for cash donations. So that's why AGI can be important. Less for capital assets. So carry over excess, if you go over this limit, you can carry over the excess for 5 years and hopefully can use it in that 5-year period. The deduction amount, right? The long-term capital assets equals the fair market value of the property. Other property equals the lesser of the fair market value or the basis. All right, so that's just a little introduction to get us started in the chapter and kind of where we're heading.